To Chapter 6 in Intermediate Accounting. We are continuing to talk about revenue recognition. This is the third video, so make sure if you haven't watched the first couple that you go ahead and do that now so that you don't miss what we have talked about already. So right now we're talking about special issues, and we are in step number 3 of 5, and we're talking about the right of return. So this right of return exists when the customer can return the good if not satisfied or unable to resell it. So, we've all done this before, right? We have all returned goods, whether it is to Amazon or Walmart or wherever we may be purchasing things from. We've all returned something because we were not satisfied with it, correct? So, this is viewed as a failure to satisfy the original performance obligation that the sellers report net sales revenue in the income statement equal to gross sales revenue less the actual estimated returns. I don't know about you, but that doesn't translate well to me, just hearing things in paragraph form. So let's look at an example instead when it comes to the right of return. So assume that Sunset Sound Systems sold $50,000 worth of equipment during the fiscal year. Industry history causes Sunset to estimate returns of 5% of the equipment purchased. So if Sunset is a new company, they're not going to have any history for themselves to say, okay, typically we see 5% return. If they're brand new, if this is their first year of business, then they're going to probably make an estimate based on other companies in the same industry. So they're estimating that out of all of the equipment that is purchased, 5% will be returned. So if their sales revenue is $50,000, 5% of that is $2,500. So they're going to go ahead and make the estimate of returns in the same year that they show the revenue. So we go ahead and we have to be very conservative as accountants. We want to show kind of not the worst case scenario, but what we are estimating it is going to look like. We know that someone is going to return things. I read recently that Amazon, I think it's at least 17% of all of their revenue is then returned. And just think that's just the people who actually take the time to go in, fill out all the return information, and then take it to the destination they have to return it. I don't know about you, but I have some items that I failed to do that within the 30-day time range. So that's a lot. But for this company, they're saying about 5% is what they estimate. So they're going to take the same accounting period that they earned that sales revenue and go ahead and show the 5% of revenue as their estimated returns. The difference between that would be their net sales revenue. That would be $47,500. Anytime we see net, you see net pay, net revenue, anything like that, that's talking about after something was removed. So with your net pay, you started with your gross pay. You're like, wow, I'm getting paid pretty well. Then they take out taxes and insurance and 401k and any union dues. And then you've got your net pay. So net is going to say after things are taken out. So here, this is our revenue after our estimated returns have been removed already. So next we're going to talk about if the seller is a principal or an agent. So this is something quite different. But for a principal, there is a performance obligation to provide goods and services, and they're vulnerable to risks associated with holding the inventory. So the principal, this is someone on behalf of the buyer, they are actually going to be holding the inventory and they are liable for that. The total sales price paid by the customers is what their revenue is going to be, and they are going to recognize cost of goods sold. So they're kind of like the middleman. The principal, this is not talking about principal and interest. This is principal as in someone who is going to be making a purchase and holding the inventory on behalf of whoever will then buy it from them. So they're like the middleman. Then there's an agent. An agent is going to be facilitating a transaction between the principal and the customer. So they are also a middleman, but they are just facilitating it. They don't show any cost of goods sold. They're not holding the inventory. They are just going to show commission when they receive the transaction. So I would say an example of an agent would be like, I guess like Etsy. I've never sold anything or bought anything on Etsy, but you know how with Etsy, if you are someone who makes a craft, you can show it on Etsy. You can, try to find a buyer using Etsy. Etsy's never going to have any kind of they're not going to obtain your inventory at any point. But whenever you sell it to a customer, they're going to get some of the commission. Same thing with eBay, right? You go and sell your old PlayStation on eBay. eBay never takes hold of the actual PlayStation, but because they found you a buyer, they're going to take some commission. So that would be what an agent is. Whereas a principal would actually take some inventory and they're going to show revenue minus cost of goods sold, because they're going to take these sellers' merchandise, have it on hand, and then sell it to a customer. So both of them are middleman, but one of them actually will take hold of the inventory, the other one does not. So let's look at an example. We've got Sunset Sound Systems. They were hired to provide high-end speaker system for a summer music festival organized by Echo Events. However, Echo Events did not want to deal with the hassle of renting staging equipment from a separate vendor, so they asked Sunset to handle it for them. So now Sunset is almost working as like a contractor in this case. Like Echo Events is like, look, can you just take care of all this for me? I got too much stuff to do. So they're delegating. Delegating is like my biggest struggle. I'm not good at delegating. I just read a book about delegating. So there can definitely be some healthier delegations that I'm not doing. So that's what Echo Events is doing. Hey, we got too much going on. We're going to take something off of us and have Sunset Sound Systems try to rent the staging equipment. So Sunset will sell and install its own audio system for $25,000, which includes $20,000 for the equipment and $5,000 for the installation. All right, so Echo Events asked Sunset to arrange the staging equipment from Stage Ready Company, the third-party vendor. Stage Ready charges $10,000 for the rental. Sunset will not mark up the cost, but will earn a $1,000 commission from Echo Events for handling this coordination. Sunset never takes control of the equipment, and Stage Ready is responsible for setup and performance. So here they're working as an agent. And the last one, I didn't point it out, but they were working as a principal, because Sunset was actually going to be the ones taking the inventory and going to be installing this. So they made $5,000 there. With this agent arrangement, Sunset just organizes it. They make a $1,000 commission. They never actually have to do anything. That is Stage Ready's job. So hopefully that helps with what the difference between an agent and a principal is. Then we jump into the time value of money. Chapter 5 was all about the time value of money. So if the time value of money is a significant part of a contract, the seller should view the transaction price as consisting of two components. They've got a delivery component equal to the cash price of the good or service, and they have a financing component, which is the interest considered paid to the customer because of the time value of money, or to the seller. So sellers can assume the financing component is not significant if the period between the delivery and payment is less than a year. So the time value of money is only going to come into play if there's at least a year time in there from the time that maybe they perform or deliver goods, or to the time that they're paid. So let's look at a prepayment situation. We've got January 1st, 2025. Sunset Sound Systems offers a live sound production service for a large New Year's Eve festival happening on January 1st, 2026. I guess that's when you got to get your contract set up. All right, so it's January 1st and New Year's is done. Well, let's go ahead and get it for next year. Let's get that gig. So that's what they did. The full price of the service is $50,000 payable on the day of the event. So Sunset is setting this up for the New Year's Eve event, but the payment is not until the event actually happens. So Sunset offers a 10% early payment discount to any client who prepays a year in advance. What will be the benefit of them getting that money a year in advance? Well, if they've got all this money a year ahead of time, they can use it for other things. That's an asset that they could invest it and earn interest on it, or they could put it into something else that will earn revenue for them. So one client accepts and pays upfront on January 1st, 2025. So they're paying a year in advance. Sunset's market borrowing rate is 10% annually. So when we use the present value chart, we take the $50,000 and we're going to multiply it times the present value factor, this 0.9091. This comes from one period because it's one period out with 10% interest. If you don't remember how to use the present value table, go back to chapter 5 where we talk all about the time value of money, and that will help you how to learn how to use these tables. So when we multiply the 50,000 by that, the present value of that is going to be $45,455, which is the discount that they are going to be giving and to allow them to only pay $45,455. So on January 1st, 2025, when they make this contract for 1 year out, they're giving the client a discount. So total, they'll be accepting cash of $45,455. They haven't done anything for it yet. Sunset has not done anything. So they're going to put it in deferred or unearned revenue, is that liability account they'll put it into. So same situation here. And whenever January 1st, 2026 comes, they've provided them with their live sound production. Now they are going to get rid of that deferred revenue for $45,455. That liability is not a liability anymore. They have now provided that live sound production service. But here's the catch. We still are going to show $50,000 in service revenue. This was still a service that they provided that was valued at $50,000. The difference between the two is interest expense. This is interest expense for Sunset because they went ahead and accepted the discounted cash a year early from their client. So they gave this at a discount, so that difference will be shown as interest expense. So the hope is now is that they were able to take the $45,000 and use it for something over the last year that made them more money than this $4,500 in interest expense. So what if we switch things up a little bit? So we're going to go back to the same scenario, except because the payment, the client agrees to pay exactly 1 year later. So they are not going to pay until December 31st, 2025. They made the agreement on January 1st, they're going to pay on December 31st. Because the payment is delayed, the client agrees to pay the interest rate of 10%. So they're actually going to pay 10% more in this situation. So there's a whole different scenario where this client says, I'm not going to pay early, even though it gives me a discount. Instead, I'll pay a year out and I'll pay some interest on top of that. So the way we calculate that interest is the present value of $50,000 divided by the factor, the 10% for 1 year, the 0.9091, and that gives us $55,000. We could have figured that out on our own, right? We could have taken $50,000 times 10%. That would have given us $5,000, and we add it back to see that we're going to be charging them an extra $5,000. So on January 1st, 2025, we will show a notes receivable, that asset of $55,000. We're going to show sales revenue of $50,000, and we're going to show the discount for $5,000. So that's that discount that they're giving them. So then, whenever December 31st comes along, we are going to show the actual cash coming in of $55,000. We're going to get rid of that discount and show it as interest revenue. So instead of interest expense, this time that $5,000 is interest revenue, and we'll get rid of the notes receivable. So on the top there, we have the January 1st entry. On the bottom, we have the entry that will be showing on December 31st when they actually pay them. So they're going to have to pay interest because they waited for a year out. Now the difference here, the reason we went ahead and showed the revenue on January 1st is this was something they did perform for them on January 1st. Then they let them pay a year later. Anytime that you agree to pay later, even if a company says, oh, we're not going to charge you interest, there's going to be interest tied into there. It will be calculated in there. So they perform the service back on January 1st, then the client pays the cash January 31st, and that's where we get to show the interest revenue. All right, just a couple more things before we end this video, and then there'll be one final video for chapter 6. So step 4, allocate the transaction performance obligations. So there are various approaches available to estimate standalone selling prices. So here's where there are more than one obligation. There's more than one thing happening here, and we are going to use a variable method, whichever one is chosen, to figure out the standalone selling price. So we have adjusted market assessment approach. This is where the price, if the product or service were sold in the market. So if we know what it would sell for in the market, then we could use that approach. We have the expected cost plus the margin approach. So we estimate the cost of the satisfying of the performance obligation, then add an appropriate profit margin to it. Or you could use the residual approach. Subtract the sum of the known or estimated standalone selling prices of other goods and services in the contract from the total transaction price. So we have multiple performance obligations happening in one contract, and we need to give them standalone prices that are allocated to each performance or to each good. So let's look at an example. Look at that. It's Sunset Sound Systems. They've entered into a contract with a customer to provide a custom speaker system and a one-day professional setup and tuning service for a bundled price of $12,000. Great. So they're going to get $12,000. The big question is, how should that be broken out between the actual sound system and the service? So we see here Sunset regularly sells the custom speaker system on its own for $9,000. However, it has never sold the setup and tuning service separately. And there's no observable market price for that service. So we can't just look at it and say, well, this is what it would sell for in the market. So if that's the case, what we're going to do, I'm sure you figured it out already, we're going to take the $12,000 that the bundle price is, subtract what we do know the value of. We do know the market price would be $9,000 if we were to sell the speaker system alone, and the difference we're going to just assume would be how much it would be for the price of the service. All right, so I'll stop here for this video. Make sure you jump into the 4th one. I would say go ahead and subscribe because you have another 15 chapters to go after this for intermediate accounting. So let's walk through it together.